There's a provision buried so deep in the United States tax code that most CPAs have never used it. Most tax attorneys have never mentioned it to a client, and most homeowners will live their entire lives never knowing it exists. It allows you to rent your own home to your own business for up to 14 days per year and keep every dollar of that rental income completely tax-free. No reporting, no Schedule E, no Form 1099, nothing. The IRS does not even require you to disclose the amount. You earn it, you keep it, and you use it to pay down your mortgage faster than any refinancing scheme or biweekly payment plan ever could. It is called the Augusta Rule. Its formal citation is Internal Revenue Code, Section 280AG, and it has been part of federal tax law since 1976. The provision was originally passed to protect homeowners in Augusta, Georgia, who rented their homes to golf fans during the Masters tournament for a few days each year and did not want to deal with complex rental tax filings. But the language of the law does not mention golf. It does not mention Augusta. It does not mention tournaments. It says any personal residence rented for fewer than 15 days per year is exempt from rental income reporting. Any residence, any purpose, any amount. The real estate industry generates over $44 billion a year in mortgage interest alone in the United States. The average American homeowner pays over $160,000 in interest over the life of a 30-year mortgage. And this one provision, fewer than 200 words in the tax code, can redirect thousands of dollars per year from the IRS back into your mortgage principal. They did not repeal it because too many powerful people use it. They simply made sure you never found out. Welcome to the Invisible Ledger. If these stories matter to you, hit subscribe and the bell. This is where we trace the money they told you not to follow. Let me take you to where this began. In the early 1970s, homeowners in Augusta, Georgia had been renting out their homes during Masters Week for decades. The tournament, first held in 1934, draws hundreds of thousands of visitors to a small city with limited hotel capacity. Residents discovered they could earn $5,000, $10,000, sometimes $20,000 in a single week by vacating their home and renting it to wealthy golf patrons. But when tax season arrived, the IRS expected them to report this income, file Schedule E, track expenses, depreciate portions of their home, and navigate the passive activity loss rules. For a few days of rental income, homeowners were being subjected to the same tax compliance burden as a full-time landlord. In 1976, Congress passed the Tax Reform Act, and tucked inside was Section 280A, which addressed the tax treatment of home offices and personal residences used for business. Subsection G contained the provision that would become known as the Augusta Rule. It established a clean, bright line. If you rent your personal residence for fewer than 15 days during the tax year, the rental income is not included in your gross income, period. No exceptions, no phase-outs, no income limits. It applies whether you earn $500 or $50,000 in those 14 days. The legal mechanism is elegant in its simplicity. Under Section 280G, the dwelling unit is not treated as being used in a rental activity if it is rented for fewer than 15 days. Because it is not a rental activity, the income is not reportable. Because the income is not reportable, it is not taxable. You cannot deduct expenses against this income either, but that is irrelevant because the income itself is invisible to the IRS. It does not appear on your tax return. There is no form for it. It simply does not exist in the tax system. Now, here is where it becomes powerful for business owners. If you own a business, any business, whether it is an LLC, an S corporation, a C corporation, or a sole proprietorship, your business needs meeting space. It needs locations for board meetings, strategic planning sessions, client consultations, team retreats, and annual reviews. Instead of renting a hotel conference room for $500 to $2,000 per day, your business can rent your home. You set a fair market rental rate by researching what comparable properties in your area charge for daily event or meeting space rental on platforms like VRBO, Airbnb, or PeerSpace. If comparable homes in your neighborhood rent for $1,000 to $3,000 per day for events, that is your rate. Your business pays you, the homeowner, the fair market rental rate. The business deducts the payment as an ordinary and necessary business expense under Section 162 of the Internal Revenue Code. You, the homeowner, receive the income tax free under Section 280AG. The money is moved from the business, where it reduces taxable income, to you, personally, where it is not taxed at all. This is not a gray area. This is two sections of the tax code working in concert exactly as they were written. Before I go further, this video is just the surface. Inside the Invisible Ledger Vault, you will find the complete Augusta Rule implementation guide, sample board resolutions, fair market rental rate documentation templates, and a CPA-reviewed checklist to make sure every step is defensible under audit. The link is in the description. But stay right here. The IRS has examined this provision repeatedly and has never challenged the core mechanism when properly documented. The key requirements established through IRS guidance and tax court precedent are straightforward. First, the property must be your personal residence, meaning you use it as your home for the greater portion of the year. Second, the total rental days must be fewer than 15 in the calendar year. Third, the rental rate must reflect fair market value, not an inflated or arbitrary number. Fourth, the business must have a legitimate business purpose for the rental, documented through meeting agendas, minutes, sign-in sheets, or contracts. And fifth, the payment should flow through proper business channels, meaning a check or transfer from the business account to your personal account with a memo referencing the rental agreement. Tax professionals at major firms including Deloitte and KPMG have acknowledged the provision in their guidance materials. The Augusta Rule appears in IRS Publication 527 under the section on minimal rental use. And tax court cases, including Razavi v. Commissioner, have reinforced the principle that minimal use rental exclusions are valid when properly structured. The numbers are remarkable. Suppose you own an S corporation and you pay yourself a reasonable salary of $80,000 per year. You rent your home to your S corp for 12 days during the year at a fair market rate of $2,000 per day. That is $24,000 flowing from your business to you personally. The business deducts the $24,000 as a rental expense, reducing its taxable income. You receive $24,000 that you never report. If your combined federal and state marginal tax rate is 30%, you have just saved $7,200 in taxes. Apply that directly to your mortgage principal. And on a $250,000 mortgage at 6.5% interest, an extra $7,200 per year applied to principal in the early years can reduce your total mortgage by over $50,000 in interest and cut years off your loan. If you have made it this far, you already know more about Section 288G than 99% of homeowners and most of their accountants. Subscribe and share this video. The mortgage industry does not want you to accelerate your payoff. Every dollar you pay early is a dollar of interest the lender never collects. On a $300,000 30-year mortgage at 7%, the total interest over the life of the loan exceeds $418,000. You pay more in interest than you paid for the house. The banking industry's entire residential mortgage profit model depends on you making minimum payments for 30 years. Any strategy that accelerates principal reduction is a direct threat to that revenue stream. The Augusta Rule does not attack the mortgage directly, but by creating a legal pathway to receive tax-free income, it gives you ammunition that the system never intended you to have. The National Association of Realtors reports that existing home sales in 2023 exceeded 4.9 million transactions. The Mortgage Bankers Association reported that total mortgage originations exceeded $1.6 trillion. The servicing industry alone generates over $60 billion in annual revenue. Every one of those numbers depends on borrowers making payments slowly, predictably, and profitably for the lender. Now let me tell you exactly how to implement this. Step 1. If you do not already have a business entity, form one. An LLC or S corporation in most states costs between $50 and $500 to establish. You need a legitimate business purpose, and if you are self-employed, freelance, consult, or run any side business, you likely already qualify. Step 2. Research fair market rental rates for comparable properties in your area. Use VRBO, Airbnb, and PeerSpace to find daily rental rates for homes similar to yours used for events, meetings, or retreats. Document this research thoroughly and save screenshots. Step 3. Create a formal rental agreement between yourself as the homeowner and your business as the tenant. Include the dates, the rate, the purpose, and the terms. Step 4. Document every rental use with a business purpose. Draft board meeting minutes, planning session agendas, or client meeting summaries. Keep sign-in records if applicable. Step 5. Issue payment from your business account to your personal account. Keep the transaction clearly labeled. Step 6. At tax time, your business deducts the rental payments as an expense. You do not report the income on your personal return. File your taxes normally. Total implementation cost, the price of forming an LLC if you do not already have one, total annual benefit, potentially thousands to tens of thousands of dollars in tax-free income that you can apply directly to your mortgage, your savings, or any other financial goal. I need to be honest with you. This strategy has real boundaries. First, the 14-day limit is absolute. Day 15 triggers full rental income reporting requirements, and you lose the entire exclusion, not just the overage. Track your days meticulously. Second, the fair market rate must be defensible. If comparable homes in your area rent for $800 a day and you charge $5,000, you're inviting scrutiny. Be reasonable and document your comparables. Third, you must have a genuine business purpose for the rental. Renting your home to your LLC so you can watch television and call it a board meeting will not survive an audit. The business activities must be real. Fourth, this does not work if you do not own a business. The strategy requires a business entity that pays the rent and deducts it. W-2 employees without a side business cannot use this provision in the same way. And fifth, state tax treatment may vary. While the federal exclusion under Section 288G is clear, some states have different rules for rental income exclusions. Consult a state tax professional. Your grandparents did not have LLCs or S corporations, but they understood the principle underneath this strategy. They understood that every dollar you keep is worth more than every dollar you earn, because the dollar you earn is taxed before you see it. For generations, families found ways to keep what they built, to pay off their homes early, to owe nothing to anyone. Then one generation was taught that a 30-year mortgage was normal, that paying twice the value of your home in interest was just the cost of ownership, and that the tax code was too complicated to understand. There was not a more complicated system. There was just a more profitable one for the people who hold your mortgage. Subscribe and share this video. Every share restores a piece of the tax code they buried under jargon and complexity. The next vault opens soon, and what is inside will show you how a $10 LLC filing can make you financially invisible to lawsuits, creditors, and anyone trying to reach your personal assets. So 6 go.